David from Melbourne, what's your question for us?
Oh, hi, I just had a question about Credit Corp's FY11 results. I noticed they were pretty good, but the outlook statement, I was just trying to decipher it. It seemed as though there's a bit of competition coming in, and I've noticed the share price has dropped a little bit in the last couple of days, so yeah, it'd be great to get your impressions on that.
No worries, David. Thanks very much for your question. Well, as we heard Roger just say a minute ago, he was just bought some last Tuesday as part of his investment. So, Roger, you like the result? Do you want to put a bit more detail around that?
Just in relation, don't get too carried away with the selling. There's a fund manager, or my understanding is there's a particular fund manager who has taken a macroeconomic view about the world and don't want to own any stocks with financial exposure. So they're selling Thorn Group, they're selling Credit Corp, and they're just happy to be out of them. So they're taking this rally that we've seen as an opportunity to get out. That's what I've heard. That's what I hear from the brokers that this fund manager is doing. I happen to know the fund manager very well, so I could probably give him a call and find out precisely why. But that's not the game I'm in. So each to their own. The result itself, I thought the only issue for me in the result was that they're moving from credit card, the purchase of credit card debt ledgers into mobile phone receivables. And I don't know about you, but I sort of think that must be a harder gig. The dollar value is lower, the nominal value is lower. You probably have to work just as hard for $50 as you do for $400. So why not go for the $400 or the $2,000 or the $3,000? So that might be a reflection of the fact that it is becoming more competitive. But I think the industry, from a competitive landscape perspective, has been very stable for several years in Australia. I don't think that's changed. Sitting in front of their television, and no doubt this isn't the only program that they watch, and so they watch a whole bunch of economists say how bad it is in retailing. And it's, there's a depression in retailing, or there's a recession in retailing, and it's terrible. But if you wait for a cheery consensus, if you wait for everyone to agree, now's a great time, and no one's going to ring the bell for you, and by then it's way too late. And if you go into an Apple store, there's no recession. You go into Zara store, there's no recession. You go into a JB Hi-Fi store in the right location, admittedly, there's no recession. Sure, retailing has some challenges at the moment structurally, and we're all aware of those. But I think there are some businesses that are increasing market share. Every time Coles and Woolies comes out with their quarterly sales results, the analysts are poring over them with, like as if they're looking for lint in their navels, going, oh, he's taken market share off him, look, their growth rate's faster than their growth rate. Well, have a look at JB Hi-Fi. Their sales were down 1.2% like for like. Harvey Norman's was down over 3%. There were plenty of retail businesses that were struggling and really suffered.
Pay out his franking credits? He's sitting on a big pile of franking credits.
Why won't Jerry revitalise the stores?
Exactly.
I mean, if he's wondering why it's all so hard, it's because nobody wants to go in the shops anymore. The offering is just not very attractive anymore. And with retail, you've got to revitalise. That's what Zara's teaching everyone in Australia. They're turning over their stock every few weeks. There's new stock in the store every few weeks.
Have you bought anything recently? Have you got a new frock?
I did get something special. And I promise you when we go out on Saturday night, I'll show you.
Excellent. I'm looking forward to that. I have nothing to look forward to. We're going to try to sneak in a quick email right now, and this is from Gemma. Would the panel discuss whether it's better to hold Woodside or the companies servicing Woodside? Any thoughts on Mermaid Marine, which had results out today? Look, first of all, brought this up because Woodside actually had their result today, and I think that their profit was only slightly above expectations. Obviously, it's a stock that a hell of a lot of people are long and wrong at around about $42. I know I bought some stock at $42 off Shell when they sold down their first lot of stock, whatever it was, 6 months ago. Our guys do think it's still very, very cheap, below $40, and still happy to have it in a long-term portfolio. So I thought we'd better start with something we disagree with. So we'll go to Roger first, and then after that we'll go on to Ben.
memory. You've got a great memory.
Well, we were just all getting on with each other a little bit too well, so
okay,
come on.
no problem.
Yeah.
Well, you know, the nice thing about it is we're just talking about stocks, not each other.
Yeah.
So
Okay.
if we stick to stocks, we'll be fine. We can disagree all we like.
Okay.
It doesn't matter. Look, Woodside for me, you know, I've got an optimistic valuation of about $21.
Yep. Why?
Which is why. Well, my valuations are a function of the economic performance of the business, not a function of what I think other people might pay for it or what they might achieve in the future.
Yep.
It's based on a demonstrated track record, and what we do is we look at what we think they're going to do over the next couple of years. And best case scenario, by 2013, their value's $24.83. Now you can sit there and you can say, Roger, well, I think you're wrong, and that's okay because you can buy it and make a lot of money, but it just doesn't fit my criteria. I've got to find the things that just fall into my funnel and fall through all of my characteristics, and the things that I buy, when I do that over time, it works reasonably well. So look, there was a time to buy Woodside, and that was in it was about November 2008. Just before, just at the
a lot of good things around about November 2008.
That was about the one time in sort of 7 years where it actually dropped below its intrinsic value.
Okay.
But its intrinsic value in 2013 will be the same as what it was in 2006. And surprise, surprise, the share price today is exactly where it was back in 2005. So, you know, there's been no net change in the share price. There's been no net change in the intrinsic value. For me, it just doesn't meet my criteria.
Oh, definitely.
Well, good evening, guys. My situation is I have a 17-year-old son who's first year uni, becoming independent. He has $6,000 to invest. Our discussions have been obviously blue chip stocks, looking at splitting it into two sectors, perhaps the obviously materials, you know, mining stocks, and then banking. But for an amount of just $6,000, a bit of advice on where to go would be greatly appreciated.
Yes, yeah. No trouble.
Talking about BHP and perhaps precious metals like the gold sector, banking stocks, are we going to be affected by what's happening in Europe and America negatively? So yes, an amount of $6,000 for his first investment. Be great to hear what you guys got to say.
No worries, Steve. Thank you very much. Well, I think the first thing I would do is I'd charge him $300 a week rent, I think, for living at home, and that'd probably be able to get, you know, retrospectively. You can catch up. I've been telling my 8-year-old he's got to start paying rent soon. But $6,000, I wouldn't muck around. I would just pick one of the banks, and I would pick ANZ first, Commonwealth Bank second, and then when he's going to leave it alone for 10 years, you don't want to muck around too much, so I'd probably just stick with BHP, and I'd do something like that and then put it away. Roger, what would you do with your $6,000?
I've gone through this exercise with my kids, but they're a lot younger, so they're much younger, but I'm going through it with them at the moment. I actually think it's useful to teach some discipline around diversification as well, and so not just to put because it's only $6,000, you know, to put it in one stock, but to actually go through the discipline of portfolio management. Choose maybe 6 stocks, 6 good companies. I heard you say blue chip. My definition of blue chip is different to the conventional definition of blue chip. Find businesses that have got high rates of return on equity, little or no debt, and are trading at big discounts to their intrinsic value. And they've got bright prospects. And that's something that you really don't need to do a lot of number crunching on. You can actually just sit back and think about the businesses that have bright futures. So I'd actually pick 6, and I'm sure you're looking for 6. So I'm happy to recommend, I'd agree with you, CBA or ANZ. I like ANZ. I think it's at a bigger discount for me to intrinsic value. If you're interested in gold, I think Silver Lake Resources would be one to look at. That's not one you can put in the bottom drawer and just forget about. Gold doesn't have an intrinsic value really, so just need to be mindful of that. We talked about Credit Corp earlier, Thorn Group, we've mentioned that's another one. Vocus, I think Vocus is one you'll probably find that it's a little bit expensive compared to its intrinsic value recently, but I think that intrinsic value is going to rise substantially dramatically over the next few years. GR Engineering is another one. Breville Group could be another one you could have a look at. I mentioned Ford, Woolworths would be another one. I think the prospects for Woolworths are very good. I don't think it's going to blow your socks off with excitement, but just there's been 7 years, or sorry, since 2007, the share price of Woolworths has gone nowhere. So everyone who ever bought Woolworths since then has become quite jaded. They don't think the prospects for the business are very good, but what they're doing is classic. They're just taking their cues from price action. The intrinsic value has been stepping up over the years, so that's another one.